My name is Joseph Coffman.
And I'm Mike Coffman.
We are two brothers, one goal, helping educators build wealth, helping them maximize their retirement benefits. Today we're going to talk about tax planning, retirement planning, a very important aspect of your retirement as you plan for it, but also in retirement. And we'll just preface this by saying we are not CPAs, so please consult your tax advisor or your certified public accountant to deal with any tax planning that's involved. What we're going to talk about today deals with taxes. We're going to talk about the current tax brackets and how those can impact you in your current income phase as you're accumulating money for retirement, but also on the income phase as you're drawing down your retirement accounts. We'll talk about potential tax benefits on retirement accounts and how to boost your retirement income through your investment accounts. We'll talk about how to allocate those funds and the investment income that those accounts can provide for you to and through your retirement.
Okay, let's get started, Joe. So one of the things that Uncle Sam likes you a lot, and so Uncle Sam will follow you into retirement. And there are, we believe, really three different tiers of tax planning. And all three tiers matter, and we want to pay attention to all of them. The first tier of tax planning is, what are your taxes this calendar year? Well, this is a little bit clearer, Joe, because we know what the tax brackets are. We can get a pretty good idea of what your income is going to be, and we can certainly strategize to help lower those taxes. Because remember, every single dollar of taxes that you pay come out of your retirement income that you are not going to be able to spend. So what are your taxes this year, and what can we do about those taxes, and what are ways that we can mitigate some of those taxes? The second tier of tax planning is, what are the income taxes while at least one of you or your spouse are alive? So when we have two spouses that are married going into retirement, typically they're going to be married filing jointly. But if one of you passes away, what's the other one's tax brackets going to look like? Now, tier 2 tax planning gets a little foggier, right? Because we don't know how long any of us are going to live. We don't know exactly what the tax brackets are going to be in the future. And we don't know exactly what your income is going to be. But it's still vital that we're planning for those taxes in that tier 2, because again, they do directly impact how much money you can spend in retirement. And finally, Joe, the third tier of tax planning is, what is the taxation of the money as long as the money's around? Meaning, you pass away, you and your spouse pass away, what are the taxes going to be to the heirs when they inherit that money? Again, third tier tax planning, a little bit foggier still, right? Because further out, we don't know how much money you're going to have, how much you're going to, how long you're going to be alive. But certainly we'll want to be paying attention to all those three tiers of tax planning, because again, every dollar of tax comes right out of your wallet. So let's dig in. So first of all, Joe, we do got to have a picture of just what the tax brackets are in 2023. You want to go through how people can use this chart?
Absolutely. So the tax bracket in 2023, as a married filing jointly, as Mike was referencing to, just show that your taxable income and the certain tax brackets that you may actually fall into. Now, when we think about filing for your taxes, most people are doing what's called a standard deduction, and that means they don't have enough itemized deductions to exceed the standard deduction. And so right now, married filing jointly is a $27,700. The first income that you earn is taken off any taxable wages. So $27,700 as a standard deduction. It does go up as you exceed the age of 65, that standard deduction. But as we go through the code, the tax code, and we look at married filing jointly, as you can see, 0 to 22,000, that bottom threshold right there, married filing jointly, 0 to 22,000. The first $22,000 is taxed at 10%. From $22,000 to almost $90,000, it jumps up 2% for a total of 12% federally. And then there's a rather large jump, the largest in the tax code, where it jumps from 12% to 22% for any taxable income that exceeds that almost $90,000 of taxable income up to $190,000. So these things are things that we talk about in planning for retirement and how we can mitigate or limit some of our taxes that we pay today by saving in tax beneficial accounts for retirement. And also it's used as we take income from your retirement accounts in retirement, and how we can mitigate or lower some of our tax liability potentially as we're drawing down our assets or taking money from our investment accounts. Now, I will say, if something happens for a married couple and one passes away, we have to consider this. What does their income look like if one is no longer here? We're now filing as a single filer. As you can see, a single filer, after the standard deduction, 0 to 11,000 is taxed at 10%. And then the next tax code of 12%, or the next bracket, 11,000 to 40, almost 45,000, taxed at 12%. And anything over 44,726 of taxable income is that big, large jump of another 10% to 22%. So just understanding where you currently stand and how we can maximize retirement benefits, and also maximize what we take out of our retirement accounts too as well. So paying attention to that is very, very important. It's an ever-changing thing, the tax code, though, right, Mike?
That's what I was going to say. Tax brackets are always changing. Some tax cuts have sunset provisions. You want to be sure that you're talking about this basically every year, Joe, for the rest of your life. You want to be discussing the taxes on your income and what you can do to lessen the taxes so that you can spend more money and enjoy retirement.
Absolutely.
Okay, so saving for the older you. The big thing here is, while we're working, we have the ability to put money into retirement accounts, and there's a lot of them. I've always said the good thing about being a teacher, you've got a lot of things going on your behalf for retirement. But the bad thing is, you got a lot of stuff going on your behalf for retirement. It's hard to really make sense of what accounts are going to impact you the most. So keep it in mind, if you have a 403B, and most educators do, if you have a 403B, there's a lot of money you can put into those retirement accounts. When you're working, you can put into a 403B. The maximum for 2023 for a 403B account is $22,500 if you're per year of contributions. If you're over age 50, you can put an additional catch-up provision of $7,500. You can really, really sock it away. Now, when you're thinking about socking away, you can either do it in a 403B, which is like the traditional method where it comes out before income taxes. You could also potentially, if your school allows it, do a Roth 403B. And we're going to talk about the difference between Roth and pre-tax here in a moment. Bottom line being, you can put away a lot of money. And the key here is, of course, starting early and often. You want to get that compounding engine started as soon as you can. The earlier you start, the more impact it's going to have on your retirement when you're ready to retire later. A lot of times, Joe, people will ask us, what's the difference between this teacher and that teacher? And why does that teacher able to retire at 55 versus the other teacher maybe working till 65? There might be a lot of different reasons, but many times it's the younger teacher might have actually saved more money. So making sure that you're doing that, figuring out how much you need to save for your retirement. You also could possibly do Roth IRAs. It's unlikely as an educator that you'd be able to do a deductible traditional IRA, but you might look into that as well. Also, HSA contributions might be available through your employer. One of the things that happens, Joe, when we're saving for retirement as we're working, it actually lowers our income that we're living off of, right? So then later on, when we're calculating how much income we need at retirement, it's actually a lower amount because we've been saving all these years. So it's important to really look at those different accounts and how they impact you and how much you need to be saving so that you can reach your retirement goals.
Been dealing with educators for a really long time and helping them plan for the retirement. They can make their retirement what they want it to be. And as Mike alluded to earlier, saving early and often, you want to have options when you meet that rule of 85, right? You want to have options. And if you want to continue to work because you want to work is different than working because you have to work.
For sure.
And all these things that we find dealing with educators are the ones that diligently sock it away early and often are the ones that are able to retire when they're wanting to retire, not when they have to retire. So, retirement accounts. Mike said that just earlier, right? There's a lot of different retirement accounts to choose from. It's great. 403Bs, right? You have that available typically through your from your current employer, where you can defer money through your payroll. It allows you to deduct it against your current income and not pay taxes today to potentially have it taxable later in retirement. You have the Roth 403B option potentially, a matching 403B, a 401A, your annuity savings account through the state of Indiana and IMPRS, any IRAs from previous jobs or Roth IRAs. You know, pensions and Social Security play a huge role in two big portions of your income in retirement. But how do the investment accounts provide income? That's a huge question, right? We get it all the time. I have this retirement account. Well, what does it mean in the way of income? And so what we try to convey to the client is to understand, hey, if we take a certain amount here, we can hopefully have money that will last us forever and hopefully a rising income. But we always say good financial planning, a legacy is the byproduct of that. And so understanding how to draw on those investment accounts and how they can equate to income is important as you're planning for the process.
You know, one of the things that a lot of people will ask us, Joe, is, you know, if I've worked for 30 or 35 years and I've been putting money into my retirement accounts, I've been putting money in, and then you get to retirement and you start taking it out. Well, how does all that work? Well, I've always liked to encourage my clients to think of their retirement accounts as the kitchen sink. There's water available. You just decide when and how much to turn it on. So some of our clients, when they retire, they immediately, the first month, they walk over to that kitchen sink and they turn on a steady stream of income. So every month, you may be able to, by working with your investment advisor, you may be able to draw a systematic monthly income right out of your investment account, your retirement account. So every 1st or 15th of the month, you can have that money deposited. Or some other people don't take a monthly income. They just take distributions as they need it throughout the year. So either way is fine. You just want to work with your advisor on how you want to do that so that you can, number one, have the right amount of income, but make sure it sticks with you all the way through what might be 20 or 25 years in retirement.
And sticking to a game plan, right? It's very important that you have a roadmap and a game plan because we don't want you to run out of money when you're 75 years of age.
Exactly right. Okay, so let's talk about investment allocation. This is probably one of the biggest questions people have. How do I allocate my portfolio? And certainly everyone is different. And so you need to make sure that you're doing something that is comfortable for you, that matches up to your retirement goals and your time horizon. Probably the number one thing is, what is your time horizon? If you're a younger teacher and you've got a lot of years until you're going to touch the money, your portfolio might be allocated in one way versus another teacher who is 2 or 3 years away from retirement. They might be allocated a different way. But time horizon, when you need the money, plays such a huge role on what your allocation should maybe be.
Absolutely.
So what else, Joe? What are some other things that people need to consider before they pick their investment allocation?
Yeah, I think they got to understand what they can handle in the way of volatility. Now, when you're working and you're trying to accumulate money, you're not necessarily too worried about the ups and downs of that account possibly, just due to the fact that you just don't need that money right now. That situation could change a little bit, but the fact that you're age 60 when you retire, you might live 30 more years into retirement. So you don't necessarily need to make a huge change to the allocation, but it should change and reflect your current objectives of income when you retire. But we also got to think of the fact that we might live 30 more years into retirement and we're going to need a rising income. So risk tolerance is very important. And are you able to deal with the volatility? Are you able to deal with the fluctuations of the account? Again, I think it just comes down to working with somebody that is understanding, a financial professional that can help guide you through the different phases of your career, through the accumulation mode, but also through the income phase.
And I think the other thing is when you're planning for retirement, you mentioned it earlier, have a plan and stick with the plan. Well, once you determine what your plan is and you really calculate how much money you're going to need each month in retirement in 5 years or 10 years or whatever, then you also can work your way backwards and say, okay, I need this much income. What rate of return do I need to try to get on my retirement accounts so that I can get my account balance to a certain level? So knowing that math, doing that math is also going to help you kind of determine what your allocation should be.
Absolutely.
Keep in mind, review your allocation often, whether it's your 403Bs or your matching accounts or the public retirement system. Make sure you're digging into those allocations to make sure you're comfortable with what they're invested in and that they match up with your retirement goals and objectives.
Inflation and longevity, right? Inflation, the rising cost of goods over time, they continue to go up over the time. I know that, a stamp, for instance, 65 years ago was what, 5 cents? And today I think we're talking about 63. I think it's about to go up to 66, I believe, in 2023. So the cost of living continues to go up, and our monthly income, if we don't have a raise to and through retirement, we're going to feel the pinch at some point because of inflation. Everything costing more today than it did yesterday. And so we have to take that into consideration in a scenario where we have a $5,000 monthly income at age 60, just based upon a 3% rising of cost of living. you would need at age 85 or 25 years from now, a total income of $10,468.
It's pretty scary.
It is very scary. So we have to have a rising income to and through retirement. Could you imagine if you started your teaching career from that first year 30 years ago, and that was your salary the entire time through your 30-year working career? I don't think that we'd be able to make ends meet. So we have to do something to combat that inflation issue as well as longevity.
Two of the things, and this slide speaks to it, two of the biggest mistakes I think that we as investors and potential retirees are vulnerable to making is not properly accounting for how long we might be alive and not properly accounting for how much inflation impacts our retirement income. We have to, because again, as the example shows there, inflation erodes our retirement income. Making sure you're paying attention to those two very, very important facts. And making sure then, we talked about allocation, going back to that, does your portfolio allocation allow you or give you the opportunity to have a rising income to offset that cost? So that's why these things work so much together. Okay, unforgettable birthdays. Everybody loves their birthdays. There's a lot. We all want to have more of them, right? But there's some really, really important ages, timelines, Joe, that really important things can happen and people need to know of. So let's start first at age 50. At age 50, when you're planning for retirement, you're still working, age 50 is typically the time that you can contribute more to your retirement accounts. They're called catch-up contributions. You can do it in your IRAs, you can do it in your 403Bs and 401Ks. So trying to plan on increasing your contributions to make that final push towards retirement, it's just very, very important. One last push. At age 55, Joe, we know about like teacher's pension. 55 is the first time you can maybe get the rule of 85, so that's very important. But what are some other things as it pertains to 403Bs and withdrawals on those?
Yeah, as a 403B that you fund throughout your working career, if you've terminated service due to retirement at age 55 or older, you can actually access your 403B account without any IRS penalty for early withdrawals. Because the next bullet point or next unforgettable birthday is 59 and a half, and typically that is the age that the IRS looks at as a way for you to take from your retirement accounts and live off of without being penalized. Of course, you have applicable taxes on those accounts, but age 55 just allows you to take from your 403B potentially and not pay any IRS penalties for taking it out.
Just make sure you talk with your school and your tax preparer to make sure that that actually impacts your situation, because there's some nuance there you want to be mindful of, but you don't always necessarily, to your point, Joe, have to wait till 59 and a half.
Absolutely. And age 62, what happens at age 62? We talked about it in the previous one, right?
Yeah. Earliest time you can start drawing Social Security. Of course, it will be reduced from your full retirement age, but you can claim Social Security benefits as early as age 62. So keep in mind that benefit's going to be reduced for the rest of your life. Don't want to take it lightly. Work with your financial planner to make sure that you are considering all the options, but you can start taking it early as 62. Age 65, Joe, what happens there?
Age 65, you want to plan if you are retired at age 65, 3 months prior to your 65th birthday, or maybe even several months before that, but definitely getting enrolled and working with somebody to get you enrolled in Medicare. That is your health insurance. All right, that's going to be the health insurance that you're going to carry past age 65 in retirement. And so working with somebody to help plan for that, to figure out Part A, Part B, the cost, a supplement as well, to understand how that's going to work for health insurance, the cost, the benefits, and everything else included after age 65.
The other thing for active teachers, age 65, still working, that new Millie Morgan rule, keep that in mind. It's possible you could draw your pension while you're still working, so you want to keep that in mind. Talk with an advisor about that. Age 70 and a half, it used to be that required distributions from your retirement accounts started at age 70 and a half, and that has been moved. We'll talk about that here in a second. But at age 70 and a half, it's an important age, because if you're making charitable contributions in cash or writing checks, and you're not able to itemize your deductions on your tax return, most of us, if we're making charitable contributions, we do it because it feels good, but we won't turn down any tax benefit. Well, at age 70 and a half, if you do it the proper way, it's possible you can actually make what's called a qualified charitable distribution paid directly from your retirement account. And you can actually make that charitable contribution and not pay taxes on the distribution. You got to make sure you're doing it the right way. There's some nuance there, but it's a really, really attractive way it's a more tax efficient way if you want to be charitable. So talk about that and be thinking about that. And then finally, as I said, the required distribution used to be age 70 and a half. They changed it to 72. And now, Joe, what's the age where you're forced?
73. The year that you turn 73, you are forced to take a certain percentage. It's a little less than 4% that first year that you are forced to take from any taxable retirement accounts that you've accumulated. So for some of you, you may already be drawn on that account and it fulfills that required minimum distribution. But for those that are not, most definitely you are forced to take it by the April 1st of the following year that you turn 73. Now, any qualified charitable donations that you do, those QCDs, are definitely used towards meeting fulfilling the RMD at age 73. So just making sure that you understand that, work with your tax professional and your financial advisor to make sure that you're meeting those required minimum distributions from any taxable retirement accounts that you've accumulated.
And the other age that's not on there, Joe, that still really does resonate and is important is making sure that you understand when your full retirement age is for Social Security. So we didn't put it on because it depends on the year you were born, but keep in mind you want to be mindful of that full retirement age for Social Security. Okay, so proactive tax planning, as we mentioned earlier, taxes follow you to and through your entire retirement. And you want to be paying attention to every potential taxation of all of your income and all of your Social Security benefits. While you're working, you want to be paying attention to the potential tax pitfalls of not contributing enough. You know, you might be able to save more taxes the more you contribute to your retirement accounts. The question of should you be doing Roth IRAs or Roth 403Bs versus the pre-tax contributions? Big question. Lots of pros and cons between the two. You want to know that they're available, and you want to be looking at those 3 tiers of tax planning to see which one of those, either Roth or pre-tax, makes the most sense for you. And then, of course, when funding your retirement account, Joe, what are the things they need to talk about and think about?
Understanding how the taxation is on the way in and on the way out of your funding your retirement accounts, but also the way that you can essentially accumulate more dollars in those accounts to provide yourself more income. And the reason for all that is to provide a comfortable retirement to and through your retirement. As we know, Social Security and your teacher's pension are great buckets of income, but the ones that really are comfortable in retirement are the ones that have funded diligently along the way their retirement accounts so that they can provide themselves with extra rising income potentially. And then the impact of inflation on retirement income, right? We understand that if we don't have a raise the first year of retirement into the 30th year of retirement, we're going to feel the pinch at the pump, at the grocery store, healthcare, all of that. So we have to understand inflation is not going away, and we have to have our retirement accounts providing some type of growth to provide a rising income. Okay, so just understand, Mike and I are investment advisors. We think it's very important that you work with somebody that understands your situation, that can help mitigate risk, help minimize taxes, and understand the tax code to understand what your pension benefit's going to look like, not only before taxes but after taxes, as well as your Social Security income, and how those retirement accounts that you can manage those to provide an income for the rest of your life.
Certainly want to be considering, again, all of your investments. Financial planner, a financial professional can help you do that holistic financial planning and help you meet the needs and make sure you fully understand. As we always say, you're only going to retire one time. You want to work with someone that's been through it many, many times before that. So
we appreciate you tuning in. Again, Joe Coffman.
And I'm Mike Coffman.
With Coffman Wealth Management. We're two brothers, one goal, working to help maximize retirement benefits for educators in the state of Indiana. Thank you.